So welcome to Unit 1, Section 5, Business Ownership. So learning objectives today is we're looking at different kinds of business ownership. So looking at sole traders, partnerships, limited liability companies, private and public. We're looking at charities and we're looking at cooperatives. And these are some of the key terms that you need to make sure that you know. By the end of this, you hopefully know what a sole trader, partnership, PLC, LTD, and a charity and a co-op is also. So, like I've said, there's different kinds of ownership that businesses can have. If we look at the left-hand side of the bottom diagram, okay, you've got sole traders and partnerships. Now, sole traders and partnerships are what we refer to as unlimited liability businesses. Okay, so basically what that means is that the people who own the business and the business are seen as one thing. So if the sole traders and partnerships run up a lot of debt, okay, the people who own the sole traders and partnerships are also liable for doing it, okay, so they might have to sell their own private houses and their private cars and their private assets. However, if we compare this to private limited companies and public limited companies, okay, what we have is these are seen as two separate things. So the individuals that own the LTD or the PLC, okay, are seen as different legally, okay, to the company. So what I mean by that is if the company racks up a lot of debt, the individuals that own the company are not personally liable for that particular debt. They are seen as two separate entities. The people and the business are two separate entities. So they have limited liability. There's only a limited amount that they can chase the debts of the business to you. Okay. So we've talked about limited and unlimited liability, but you can pause here and read some of the slides. And I'll be doing that throughout, okay, where you can pause and have a look at some of the additional slides. Okay, so first of all, a sole trader, quite a simple definition here, is pretty much a business that is run by one person. Okay, we often see sole traders in sort of small shops, could be corner shops, takeaways, these sorts of things, and they generally operate on a local level. Okay, so being a sole trader, there's a lot of advantages. Okay, you're your own boss. Okay, you get to keep all the profit. Okay, and you get to make all decisions. You retain a lot of control of your business. All the decisions come through you. However, there are some disadvantages to it. Because you're the only one bringing money and ideas to the business, you fail to bring, again, new ideas and new finance into the business. Also, if you're a sole trader, let's say you are a sole trader who's a plumber or a builder or something like that, and you say get injured playing sport on the weekend. Well, often if you're not opening and running your business, you're not able to make any money. So it's very difficult for you to have time off. And obviously, a sole trader does have unlimited liability, meaning that if your takeaway, your taxi company, or your local shop runs up a lots of debt, then you as a person are liable to pay them off. Okay, so there's some example. Again, pause it if you want to have. A partnership is a business that is run between 2 and 20 partners. You see these in a lot of, say, solicitors, dentists. So you've probably seen solicitors that are called like Jones, Davis and Evans and so on. That's an example of how they are a partner. Now they are, again, have unlimited liability. Okay, there are a lot of good things to being a partnership, and I'll discuss those on the next. Okay, so basically what it means is that you have extra capital available, so more than one person investing into the business. Okay, the workload is shared, you can maybe take additional holidays, there's less stress involved, okay, and people can bring, if you're inviting new partners on, that they can bring in new skills and ideas and additional investment in it, okay, and people can bring sort of different specializations to the firm. Let's say one person is good at marketing, one person is good at finance, they can take control of that. Okay, but there are downsides. Okay, you can disagree. Okay, maybe you start to lose an element of control of your business. You have to share your profit. People aren't their own boss. Partnerships have unlimited liability. Okay. Okay, so we're now moving on to looking at companies. We're looking at PLCs, so public limited companies, and then private limited companies. Now, the difference between a public limited company, a PLC, and a private limited company, an LTD, is that a public limited company, anyone can invest in the firm. Okay, a private limited company is you have to be invited to be a shareholder. Okay. Now, where a lot of people get confused is when they hear public limited companies, they think it is a public sector business and private sector business. Okay, a public sector business is a business run by the government. A private sector business is run by a private individual. But we're not talking about that. We're talking about private limited companies and public limited companies. Nothing to do with the government and so on. It's just literally the fact that people are, it's to do with the buying of the shares of companies, okay, and the fact that they have limited liability. Okay, so do not get those confused. Okay, we've discussed what limited liability is, and I feel like hopefully you feel pretty confident with that, but pause this if you want to have another scan. Okay, so private limited companies, LTDs, they're pretty usually small to medium sized, okay? And they're probably run very similar to, say, a partnership. Okay, so there's probably a number of different shareholders within the business. Okay, and they've had to gone to a solicitor to set up as a private limited company. So you've probably seen some companies with the letters LTD after it, and that suggests they are a private limited company. Okay, so they now have limited liability. Okay, now, the way they are different to public limited companies, like I said, a private limited company, you have to invite people to be a shareholder. Okay, not any random person can invest or have a share in your business. Okay, now obviously real good because you can get raise more finance by selling more shares. You got limited liability, which is obviously fantastic. Okay. They're a bit cheaper to set up to compare with PLCs, okay, and they can't be taken over. Okay, so you see a lot of so if you follow Manchester United at all, Manchester United are run by the Glazers, and the Glazers turned Manchester United from a PLC, which is a company that anyone could invest in, and they turned it into an LTD. Okay, so basically no one can take over Manchester United now, whether you see that as a good thing or a bad thing. Disadvantages, okay, they're probably more expensive to set up than sole trade as a partnership. You have to publish your account so you can see your competitors can see that, okay. Because the owners may be not liable for the event for any debts that are run up, okay, maybe you could maybe say that the shareholders don't sort of care so much that they don't have to pay these debts back. So it's because it's the company declared bankrupt, not the individual, okay. Public limited company. Now, public limited companies are companies that are traded on the stock exchange. So you, your parents, your grandparents can buy shares in a public limited company. Okay, so it's real good. They can raise loads and loads of finance through being a public limited company. Okay, because people are constantly buying their shares. Okay, now they're usually well-known large businesses. Okay, so you've probably seen examples of companies with the letters PLC after it. Okay, and there are a few more advantages on there. Pause it and have a look. Okay, but then there are some downsides. It can be quite expensive to set up as a PLC, so it's not open to all sizes of business. Okay, and again, like I said, with a private limited company, okay, you don't really control who invests in your firm. Okay, so because you're not inviting people, anyone can buy in. You have less control over who is a shareholder. Okay, and again, you could probably say that because the people aren't liable for the debts of the business, then maybe they aren't running the business as frugally as they potentially could. Okay, so we move on to cooperatives. Okay, now cooperative is an organisation that is owned and controlled by a group of people who have an equal say in the running of the business. Okay, and then they have a share of the profits of what the business make. They call this a dividend. Okay, owners cooperative are called members. Okay, so the way that the co-op is set up, like the one in Lanny, is basically set up by the people So they're a sort of a value-based business where they take all these factors into consideration, okay, as probably over profit, which is why maybe you see Co-op is more expensive than if you went to Tesco. Okay, Co-ops are good because there is a focus on giving better customer service, making sure that the members are happy, that you're getting a dividend, okay. And generally sort of is an ethics-based business. Ethics is something that we did in Unit 2, and we'll retouch on that soon enough. Disadvantages that maybe the business isn't as profitable as it could be. Okay, it can be difficult to make sort of business decisions that might not be seen as ethical, like things like job cuts. Okay, and it's difficult because they're an ethics-based business. They maybe don't offer top salary, so it's difficult to attract real sort of top candidates to help run the business. Last one is charities, and these are groups that focus on raising money for causes like cancer research or poverty. Okay, and it's a non-profit organization. Okay, so they try and maximize donations and keep costs down as low as possible. Okay, and they do employ some people though. Okay, but generally run by volunteers. Okay. There are a lot of groups of these, okay, and like I said, they are run as not. Now, there are a lot of different ones. There's some good examples here, and you can see on this screen how much money they tend to raise. Okay, now, how you go about choosing what type of structure you're going to have is how big your business is. Okay, sole trader is small, a PLC is large. How much control you want. If you want all the control, be a sole trader. If you're happy to relieve some control, you can go partnership or whatever. Okay, how much liability you are, how easy is to set up. So a sole trader is much easier to set up than a PLC. How much profit you're willing to share. Okay, some businesses, okay, can change their type of ownership. Okay, so they might, okay, through the different kinds of stage. So a look on this final slide. Okay, a lot of these large PLCs started life off as a sole trader. They became a partnership, and then all those shareholders made it a private limited company, and then decided to take that firm public. Okay, so you can move through the different stages. Okay, so that is everything about business ownership in about 12 minutes. Okay, hopefully you got quite a bit out of that, and I didn't rush it too much. Thank you very much.